The first story of tonight is Neel Kashkari, who is the Fed president from Minneapolis. And in case you guys don't know how the Fed works, is that the Fed has different regional presidents, and they form the FOMC committee. And Jerome Powell is the chairman, so it's kind of like the leader of the committee. But in order for them to vote on like rate cuts and rate increases and stuff like that, they all kind of have to agree with each other, right? So people do pay attention to what the regional Fed presidents say. And Neel Kashkari is the regional president of Minneapolis. And he said today that the Fed might not cut rates this year at all if inflation is sticky. So this caused the stock market to decline. So if I put up a chart of the S&P 500, and this is true for like the Dow Jones and other indexes as well, you can see that it was mostly green for the day. And then Neel Kashkari spoke, and then it just kind of went off of a cliff towards the end of the day. So this was kind of, I guess, shocking to the market, which maybe it shouldn't be, because the Fed has said that it'll depend on the data on how inflation is before they make the decision to cut, but we can discuss about that later. Basically what Kashkari said really spooked the market. And also there's, maybe other reasons as well. There's geopolitical tensions in the Middle East that's really heating up, and that's driving oil prices to go up. So that might be another reason why the market is kind of scared of. There's a lot more fear in the market now compared to before. There's a bunch of this jitters in the market. And then the second part of this story is that due to the recent pullback, the U.S. money market funds, the amount of money in U.S. money markets has exploded to 6.11 trillion. So this is the highest level ever. And in case you guys don't know what money markets are, so money markets are basically like, short-term cash equivalents, like short-term treasuries, basically stuff that earns interest and is like equivalent to cash. And because the Fed has raised interest rates, the return you can get on money market funds has also increased, right? Because it's directly correlated with the Fed funds rate. And the same thing is true here in Canada, where the Bank of Canada has increased interest rates as well. So an example of money market funds is like cash.to, which is the Horizons Investments money market fund. And that one, I think, yields 4.5%, something like that, or 5%. Basically those funds have become really popular as people just want a way to kind of generate some yield on their cash in a very safe way. This could be good and bad news. This is like bad news in the short term because people are obviously taking profits and taking money out of stocks and things that they're up on and then putting them into money markets. But then this also means that it could be bullish down the line because there's a lot of money on the side. And if the Fed starts cutting interest rates, the money market yields are going to drop. And then the idea is that people will flood this money back into the market and cause stocks to go up again as they look for yield. So this is kind of the idea. So basically these two stories together, just wanted to get you guys' thoughts on it. And I'm going to toss it to Tristan first. So you said earlier during one of our group chats that you don't believe that the Fed will cut rates at all this year, which, by the way, I'm not saying you're wrong. It's just it's contrary to what the prediction markets are predicting right now, right? So if I pull up the Fed Watch tool, there's right now, at least, there's a 99% chance. It's saying that there's a 99% chance that there will be at least one rate cut by December of 2024. And I think during the last Fed FOMC meeting, the Fed put out this report called the STP, Summary of Economic Projections, where they projected that there were going to be 3 rate cuts this year. But then again, Neel Kashkari from the Fed has just said that there is a chance that there won't be any rate cuts this year. So you might be right on this, but could you just explain kind of what your thoughts are and why you think that there won't be rate cuts this year?
Yeah, so regarding the rate cuts, looking at the way that the Fed has been acting with regards to increasing rates and cutting rates, and the fact that inflation seems to have slowed but not completely petered off. I think that inflation is going to keep being sticky for a while now. And because of that fact, we're going to have the Fed is going to back off on cutting rates, even though they probably should cut rates sooner. And I think a lot of that will have to do with the fact that oil will be increasing potentially from tensions in the Middle East. So I think that there's a good chance that inflation sticks around, and the Fed's entire mental process, it seems, tends to be like inflation is here, rates high. So I think that the likelihood that they cut rates, especially because I think that they seem inclined to hold rates stable, like at the higher level, when they seem to have opportunities where they could cut them, like in the past. I think that it seems kind of more likely to me that the Fed keeps its kind of just in case we don't want to cut rates too soon, so we'll keep rates high. And I think that because of that, it will spill into all the way through 2024. Like we're already 4 months into this year, and there haven't been even a real potential for rate cuts to have happened. So I think that with that in mind, the fact that they haven't really made much, and there's been a lot of speculation that rate cuts were going to happen. I don't think the Fed is just going to cut them on a whim, and I think that the Fed is seeing this stickiness, and it's just going to keep them high longer than even they should. And the difference is going to be also the fact that they're just increasing inflation, and the fact that there is the whole argument between like the new budgets and stuff where the budgets aren't being approved, and like the debt tracker, the debt clock, right, where they've got keep having to renegotiate their debt scenario. I think all of those are factors, and that I think there's a potential that Biden will incentivize them to keep rates higher, even though it's an election year, because if he cuts rates and it doesn't go up, then it's going to look really bad as well. So I think that there's a lot of risk involved with them making major moves this year, and whoever's the next president will likely have an opportunity where they will make the actual decision, probably more so in January, would be my guess. I think that they're going to cut them early 2025 would be my guess, but maybe I mean we're all kind of speculating, and maybe my reasons for this are a little bit more based in basically the way they've been handling this so far in the current crisis. But what are you guys' thoughts? I'll toss it back.
Okay. I guess I'll speak out about this as too as well. So like I was speculating. This is more of like a just trust me, bro. Like premise, but like there might be a little backbone behind it. So like I was thinking winter 2024, and then the reason for my speculation was kind of more so on the fact that summer's coming up. So I think with that being the case, a lot of the economic circulation is going to happen. Like people will be outside. People are going to want to go to Banff here in the background, and people will want to like, have barbecues and stuff, and like spend a lot more money, travel a lot more. So I feel like that can contribute to a lot of spending and, money circulation. So that could be better for the economy overall. and then like the government might see that and it might actually benefit, and potentially rate cuts might happen. And on the flip side too as well, I think a lot of the big S&P 500 companies are figuring out ways to make money regardless of the financial and like economic situations. So if they're making money, maybe they're able to pay their workers more, or I mean, I don't know the specifics, but this is all speculation. They might be able to pay their workers more, and if people are getting paid, then more money will circulate. This is just like ball in the park, no idea, but I'm just speculating. So maybe winter 2024, like the Fed will see, like, oh, I guess we're doing a little better, and then rate cut time. Who knows? I can't say. I'm not a mind reader or a fortune teller, so.
Yeah, so my base case is still that I think that they will cut rates this year, whether it's because before I was pretty determined that they were going to do it in June, and given all these like new stuff that has happened, like the geopolitical tensions really heating up, and oil going up and gold actually going up, gold at all-time highs. I gotta say that I did not foresee this particular set of events. So now I'm a lot less confident that they're going to start cutting in June. However, I still think that there's probably going to be at least 2 rate cuts, or at least one to 2 rate cuts in 2024, whether it happens in June or whether it starts in September, as a lot of people are saying. And at the end of the day, I don't think it really matters, right? Because like 25 basis points, which is how much they're gonna cut by if they do cut, I really don't think that it's gonna make that much of a difference in the long term. And maybe a counter argument against what Tristan said earlier about not cutting rates is that just the fact that the rates are really high, the interest that's being generated, it's going somewhere as well, right? Like there's people that are holding this debt, that are milking this yield, and because this yield is being generated, people are gonna spend this yield somewhere else, right? And that's good. That's to an extent stimulative to the economy as well. So I think maybe the Fed is really stuck in between a rock and a hard place, in my opinion, right? Because they really do want to lower rates. Like if you look at the Jay Powell speeches that he has been like talking about, people were saying how, oh, he's going to be so hawkish and he's going to smash the markets because the latest CPI reports have all been hotter than expected. But no, every time he's come out, he's sounded more dovish than expected. And this is because I think, in my opinion, that deep down inside, he really wants to cut rates, but he can't when the CPI reports are still always coming out hotter than expected, right? But I think that as soon as this turns around, there's one reason, or there's one excuse that he could find that wouldn't make him look bad if he were to cut rates, then he's going to actually do it. So whether that happens in June or whether that happens in September, I don't know. But I think by the time that the end of the year rolls around, you'll definitely see inflation kind of moderating. So by the way, I'm not just saying this, right? Like if you pull up Trueflation, they did have an adjustment at one point. It showed like 1.37%, I think was the lowest it showed. So they did adjust it. And right now the lowest point I think is at like 1.9 or something, which we're below 2% on Trueflation, right? So it did end up being a little higher than expected, but Trueflation still shows us being under 2%. So I think that overall, it's hard to predict inflation, right? Because there's so many different moving parts. It's just really hard to say what exactly will happen. But I think the Fed will start cutting rates just because the political pressure is going to ramp up, and it's just not a good look for Biden going into an election with 0 rate cuts under his belt, right? Because that means that he still hasn't been inflation by that point, and high interest rates do really put a damper on the economy as well. So yeah, I mean, I think you might expect the theory is Biden might give Jay Powell a phone call soon, sometime this summer, and be like, "Hey, bro, what's going on?" Right? But at least that's the theory. But yeah, that's all I have to say on that. But before we move on, regarding the money market of funds at all-time high, just wanted to get you guys to speak on that as well. Specifically, what do you guys think about that? Do you think that that's a catalyst for maybe stocks to go higher later on, or do you think that people are or do you think that people are still gonna put money into the money market funds and accumulate this interest and just milk it for the time being?
I'm not sure if I would describe it as something that's kind of bullish, because I feel like you were kind of suggesting that this may be a bullish response, in the sense of like, oh, they're stocking up on money. Well, the rates are high, and then they're going to move it into the stock market when rates come down. I kind of see it also as maybe that they are worried that the stock market is going to crash when rates come down, because the stock market is artificially being inflated by people who are trying to avoid the rising inflation by putting more money into the stock market. And then those people may, pull money, and then it could actually be like a bearish catalyst for a short amount of time. Not for, obviously not forever, but like for a short term. Like the fact that it kind of feels like they're stocking up on cash. And when people are stocking up on cash, usually it's not that they're expecting a bull run. It's usually that they're expecting a bear section that they can buy the dip on. And so I'm a little bit, concerned that this is an example of them stocking up on cash and getting ready to buy a perceived dip that will happen with rate cuts. Because in the past also, like, rate cuts aren't necessarily immediately a zoom to the moon on all stocks. It's usually a lagging entity. So like there's no guarantee that they're going to go up so substantially in the short term. And I think that a lot of this does seem to suggest that they are preparing for a market dip. And given that some companies, I would say, seem a little bit overvalued, I think that there is potentially a lot of people who are looking to take advantage of perceived bubbles or anything to that effect in the market, where the value of the stocks don't necessarily equate to the value that's being placed on them. So I'm a little bit concerned by that action.
Yeah, like I said, like in the short term, it is bearish, right? Because it means that it looks like people are hoarding cash. And how do they get the cash? Well, they sell stocks, right? But in the long term, what I kind of was implying was that maybe this is like a catalyst for bullish long-termness, because every time there's a dip, people will have like cash on the side they have dry powder to throw in, right? So, it's kind of like a double-edged sword in that sense, where yes, there's like the amount of cash going up right now is bearish, but maybe over the medium to long term, it could be bullish. But yeah, Dom, what do you think?
Do you actually mind repeating your question one more time?
Yeah, my question was, what do you think about the fact that the money market funds have hit an all-time high of $6.11 trillion? Do you think that this is a bearish catalyst or a bullish catalyst, or like what do you think of this piece of news in general? Like, what's your initial reaction hearing about this?
Bearish catalyst or bullish catalyst? Like the only thing that comes to mind is maybe people are just afraid. I don't know if I'm like going around like true. Never mind, I'm not gonna go there. But there's like a category of people who are like close to retirement, and then those type of people are just trying to look for the most safest option possible, like at this current moment in time. And then having like 5% on cash.to is like quite nice. So I see why a lot of people are doing it. Maybe people are just searching for the most possible safe option in the market current to time, because right now it's really unpredictable with like the wars going on, whatnot. I'm not really sure. I guess that's the only thing that comes to mind. So yeah.
Yeah, I just wanted to add one thing quickly. And one thing I just want to reference just to point out is that them being at all-time highs is not necessarily that peculiar in the sense of like the money supply has increased substantially. So them being at all-time highs is not necessarily the big waving flag that it could be. It's just the fact that there's more money supply. If more people have moved into there, or honestly, if just more capital has moved into there, it's not necessarily like indicative of everyone being, oh no, the stock market's going to crash. It could be just that there's more chips on the table, and therefore more chips were moved into the money markets instead of other things. So just wanted to toss that out there.
Right. Yeah. It's not inflation adjusted, is what you mean.